The stock market, I realized, wasn't doing it for me. I tried that for a hot minute. I've been investing, 401k, retirement, blah, blah, blah. But when you actually actively try to invest in in the stock market, or when I tried just trying to find something that would work, it just wasn't working. And I realized even with my retirement accounts, it just wasn't really that great. Then you start studying the wealthy and you look at real estate as a major staple of how the wealthy grow their wealth and store their wealth, hedge against inflation, tax benefits. There's a lot of great reasons.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Flint Jamison. Flint is the founder of Vestus Capital. He spent 20 years in aerospace as an engineer and program manager. He founded Vestus Capital to help educate other engineering leaders on how they can grow and protect their wealth by passively investing in commercial real estate. Flint, welcome to the show.
Thanks for having me, Tim.
Yeah, and it is great to have you here. I'm excited. I have to give a quick disclaimer for anyone watching this episode on YouTube because it is the week before Christmas, so I am wearing my ugly Christmas sweater. I just didn't want anyone to think this is my regular attire if they're watching this. But that out of the way, I gave a little preview of your background, but I tried not to give too much away. Please get into the details of how you got started on your journey and tell us how you got to where you are today.
Yeah. We'll go in the way back machine. As mentioned there, I did aerospace for 20 years, designed the 787 aircraft for the Air Force, ran a manufacturing shop for a little bit there, doing composite materials, actually prosthetic feet. Those are our bread and butter, but we also made, alongside those, we made aircraft parts. But it got to a point where I knew that life was a grind. 20 years, every year was a grind. Just long hours, huge expectations. Aerospace industry is not easy. It is a sexy industry. Like, you can go to the bar and tell really good stories. I design aircraft. The reality of fact is it's a huge grind and it burns people out. And I needed to find a better way. I didn't want to do that my whole life. I wanted to live my life. Started thinking differently. The stock market, I realized, wasn't doing it for me. I tried that for a hot minute. I've been investing, 401k, retirement, blah, blah, blah. But when you actually actively try to invest in the stock market, or when I tried just trying to find something that would work, it just wasn't working. And I realized even with my retirement accounts, it just wasn't really that great. Then you start studying the wealthy and you look at real estate as a major staple of how the wealthy grow their wealth and store their wealth, hedge against inflation, tax benefits. There's a lot of great reasons. So I dove there when I ever looked back. I bought a duplex in 2018. It was the BRRRR strategy: buy, rehab, refinance, repeat. It was a distressed property. I bought it for $80,000. I put $30,000 into it. And then here's the thing about single family homes that I learned in that process is you don't always make a huge amount of cash flow from a single property. There's people out there that, they paid down their mortgage and all that, and they're making $1,500 a month or something crazy. But on average, you're going to make $200 to $300 a month per door. And I got this statistic from Bigger Pockets, I think, a few years ago. And I was getting that. I was getting 300. I'm like, sweet, I'm above average, above the 200. But then you expand that on, how do I retire early? How do I live off of this cash flow? I would have to do that 50 more times. The amount of capital plus the effort it took me to do that, to get $300 a door, was going to take me forever. Then I jumped into syndications from there. So now, from 2018, doing that duplex, to here at the end of 2023, I stopped counting because I think it's a vanity metric, but there's 1,500 to 2,000 units within my portfolio that I'm spread across.
So I'm going to get into a couple of the things that you talked about, because I see a lot of parallels between like how you got into it and how I got into it as well. And I think we made the switch for a lot of the same reasons, right? We wanted to grow cash flow, income from real estate for all the amazing benefits that it holds, tax-wise and everything else. And so like you, I bought a duplex. I think I bought mine in 2014, right, for $85,000. And what I came to realize is the same thing you did, that I had a formula set up. Like, I was going to make $200 free cash flow after paying the property manager and the mortgage and maybe some of those additional costs associated. And I was like, that's great. It's $200 cash flow, but someone else is paying the mortgage. I'm doing all the right things. And I think that's generally true because it's certainly better than doing nothing. But all it takes is one event that's expensive to wipe out even like a year's worth of that profit, in quotes, that you're getting from that 200, in your case, $300 a month, right? I had a tenant move out within 3 months of owning that duplex, and they just left everything there. They just left in the middle of the night, right? Because they weren't able to pay their rent. And so they're like, I'll just skip. Okay. Yeah. But then I had to pay like between $2,000 and $3,000 just to get their stuff out of the apartment so that I could then pay to get it rent ready to get a paying tenant in there. And all of a sudden it hits you. You're like, okay, that $200 a month that I was expecting in profit, that just got wiped out for a while. And then you talk about, again, doing that. Okay, if I'm buying a duplex each time, I need to buy 50 duplexes in order to reach my freedom number, right? Yeah. Replace my W-2 income. And I was like, maybe that isn't the right goal, and maybe this isn't the right way to go about it. So it sounds like you came to some of those same realizations.
Yeah, absolutely. And I totally get it. There's a windstorm and took down a tree branch and took out the fence, and there goes 6 months worth of profit.
Yeah, and that hurts. And again, I still think it's better than doing nothing by all means, but I also think there's better ways. And you talked about the same thing like with the stock market. Sounds like you tried to get into like active trading for a little, picking stocks. Is that right?
It was picking stocks. I wasn't doing options or anything crazy, but I was just trying to find a stock. And I was starting to listen to podcasts of people that are like, here's the formula for choosing a great stock. Because it's in the stock market, you follow the Warren Buffett rule, and it's you find a really good deal, then you sit on it for 30 years. And for Warren Buffett, it worked because he started out with $1 million and just blew up from there, and he's buying stocks at discounts, which none of the rest of us normal people are able to do. So you have to take things with a grain of salt with these people that have really succeeded. They started in a different position that enabled them to take better positions than what we can do. And so I came to the conclusion, I'm like, I'd rather have my money working for me than put things in these 20-year, 30-year long bets and hope for the best when maybe I can retire sooner.
Yeah. And the only thing I was going to mention on top of that is that when it comes to picking stocks, like 99% of people are just really bad at it.
And I was.
And a lot of that is just human emotion. Like we know we're not supposed to buy at the top and sell at the bottom, but most of the time that's what happens just because emotions override logical decision making. And
and here's the...
No, go ahead.
Yeah, the other thing, you mentioned a great thing, the emotions. The stock market is also driven by emotion. So I love to use the Elon Musk buys Twitter example, because when he bought Twitter, Tesla stock dropped. And the business of Tesla, the revenues didn't change overnight. So why did the valuation change? It's purely because of the emotion driven behind it. Oh, no, Elon's going to be spread thinner, and now he's not going to have the ability to manage Tesla more. And so now it's not worth it. It's right. It's just big emotional thing that lasts a hot minute, and then Tesla stock came back up. But commercial real estate is driven more so on the numbers and the revenue versus the emotion of the moment that the stock market is.
No, I agree 100%. That's why I'm not one of those people who say don't ever invest in the stock market. I don't think it's realistic. I just think more people need to diversify out of the stock market, because literally all their investments are in the stock market. They may say, I have a Roth IRA and I have a 401k. And I'm like, yeah, but it's all in the stock market, right? Yeah, I guess so. And so that's what I try to urge people to do, not necessarily get out of the stock market, but to diversify away from it a little bit so that you're getting into these assets that are less emotionally driven, like you talked about. And I think the other important point is having control over it, right? Even in the case of that duplex, you have the opportunity to add value to it. You bought it, you sunk $30,000 into it, and you were able to get more rent for it because of that. And it's really no different than what we do with, say, commercial multifamily. We buy it, we add amenities to it, and then we're able to charge higher rents. You just don't have that same control over stocks because they're companies, right? The analogy I like to tell people is it doesn't matter how many cases of Coke I drink. I'm not going to push the price of Coke. It's just not going to happen, Coke stock. So I have zero control over those assets. But with real estate and even commercial real estate, we do have some level of control there as long as we buy right and implement the business plan correctly.
Yeah, absolutely said.
All right, so let's go into what you're doing now in terms of commercial real estate. And a lot of people may not even know this, but there's a ton of different asset types within commercial real estate in general. I know a lot of times when we're listening to the news, people just say commercial real estate is down, commercial real estate is up. And to me, that's so generic as to lack any meaning, because they could be talking about a 1 million square foot warehouse, or they could be talking about a 1,000-unit apartment building, and they're not making a distinction there. So talk to me a little bit about what asset types you invest in and why you think those are the right choices for you and your investors.
Yeah, so you made a great point. When I talk to new people at networking events or just anybody new investor, and I say, I invest in commercial real estate, the instant they hear commercial, they're thinking office building. They're like, whoa, that's a horrible decision. I'm like, what do you mean? There's so many vacant offices around. I'm like, okay, yeah, office I don't touch. Commercial real estate consists of all these things, as you mentioned. And I say, no, I invest in the basic human need of multifamily, like apartment buildings, and build to rent, which I'll get to here in a second. So we'll start easy. I largely capital raise. So I partner with experienced teams. I serendipitously fell into this role, which was great because when I was working my W-2 as an engineer and program manager, actually, I was working nights and weekends, and it was easiest for me to fall into the capital raising role because I was working, it's a remote position. And I can bring not only my own money, my family's money, and my investors' money to experienced operators. Because if I jump into this just with a new partnership, me and 5 other people go buy an apartment, we're going to be like, this is our first deal. It's harder to raise. But if I'm like, hey, I got these guys that have done 10 properties already, 5 gone full cycle, they've got this business plan figured out, they are the experts in this, like the experts in Dallas Fort Worth, it can bring a lot of credibility, and investors tend to like that position more. So I'm a little more asset agnostic because I'm able to partner with the experts in their given field. But within my portfolio, I have just standard Class B value adds. I haven't gone super Class C, like super distressed properties. I have Class A's. I have brand new off of the builder Class A's to just like 2009 built townhome community. I have fund of funds where it's multi properties, 3 properties in one deal. And then now I'm doing built to rent. I don't know if you've spoken much about built to rent, but that's usually a new asset class people haven't heard of. So I can dive in there if you want.
Yeah. So, and we'll get into that in a second. You mentioned fund of funds. I was going to assume that's how you're primarily raising, just for legal reasons. But can you go ahead and explain to the listeners what a fund of funds is, and if that's how you primarily raise money?
It's not primary. I only have one now. It's not saying I'm not going to have more later. Mm-hmm. So you can think of a single property as a fund, just a single fund. If I want to create a fund of funds, what I end up doing is I raise, say, $1 million with my investors' money. And then that fund of funds is its own LLC, which becomes a limited partner or passive investor into the primary fund. Primary fund being whatever it is, whether it's a single asset or a portfolio of assets. But I just create like this sub LLC that is its own contained fund. So yes, as you mentioned, at that point, I'm only a fund manager and I am the passive investor, or we collectively are the passive investor to the primary investment.
Okay. So on the other deals, you're a general partner on those.
I do. Yeah. I'm on the GP side, co-sponsor, and I do, to fulfill my SEC duties, I do various levels of either asset management or I've done marketing. I've helped develop websites. It's just crazy because building Vestus Capital, I've become like multi-versed in various things, I'm capable of coming in and filling a gap where either they don't want to do something or helping out where needed.
Yeah, and just for the listeners, what he's talking about there is if you're a general partner on one of these syndication deals, there's a legal requirement by the SEC that every one of those general partners plays some kind of active role, that they're doing something, that they have some level of responsibility in the deal, that they don't just come, say, here's $1 million, and then walk away, never to be heard from again until the deal exits. That's not what the SEC wants. They want everyone to have, what we would probably call material participation in those deals. Just again, so that everybody's clear on that point. Okay, so let's go to build to rent, because we actually haven't had a lot of folks on the show talk about that. So I'd be interested to hear more about like your pitch for build to rent and why you think it's a great investment opportunity for people.
Yeah, build to rent is a single family home community. You basically do a single family development, but with the end goal of managing it as if it's a multifamily property. So we put in place property management, on-site maintenance. We have a clubhouse, we have the pool, all those amenities. But every house is, rather than tenants living in an apartment, tenants are living in their own single family home. And these are largely starter family home size. So where this fits is there's a huge demand for single family homes, especially the starter home. After 2008, there was the major slump in house building for starter homes. The reason being, developers made very slim margins on starter homes. So they started we'll just build bigger homes, like 2,500 square foot or bigger. They make bigger margins. So there's a major slump in starter homes. And then the housing prices go up, and you got a whole bunch of millennials in their peak family building years who are trying to move from an apartment into a house. There's not enough market for houses or starter homes. So we're feeling this is the best solution to fill the market with more starter home size homes, but they can rent them because homes these days are still out of reach for a lot of people. So this kind of is the best solution to enable people to get into their own home and make it feel like a home. They have a little front lawn, a back lawn, the amenities. So it's like an A++ category if you're thinking like Class A apartment buildings. Now we have like Class A++, which is you get a home.
Yeah, and that makes a lot of sense. I think most people, at least who are listening to the show, are well aware of the housing shortage, and that has not gone away at all. It's still pretty acute. Some of the questions that I think through, because I'm coming from the multifamily lens primarily, is how does it differ as an investment? Most deals that I've done on the commercial multifamily side, there's a hold. It used to be 3 to 5 years. Now it's veering more towards the 5 to 7, just because of market conditions. That money is locked up, and you may get quarterly distributions, but you get that nice big check at the end. What does it look like from the investor perspective for these build to rent? Because they are more of like a development.
Yeah. Okay. So great point. There's a differentiator here that we actually, in May of this year, we closed on a 2009, built in 2009 community, 94 units. And we actually pitched it as built to rent. So it was like a value add Class A property. So you can consider the same formula for that as apartment buildings. It's just townhomes, and it is a 5-year plan. On the flip side, what really built to rent, majority of the opportunities out there, in particular what I'm doing as well, is development. So we go in and we buy a piece of land, we entitle it, zone it, permit it, engineer, and then we build. There's a lot, it depends on this, but a classic case of, hey, we're going to build 150 homes in Phoenix, Arizona. We believe we can be done in 18 months, and then we're going to turn around and sell it. So this is a much different play, a development play versus a stabilized play. We do want to ultimately just sell and get out. There's no cash flow. This is, you're putting your money in and you're waiting. And the goal is with development, because you're starting off with a piece of dirt and you're building things at cost and then selling things for what the value is in the end, you tend to get a much higher yield on cost that happens quicker than your value add assets. Now you have to contrast that to the risks of development, which is a bit nuanced. And I think the general public just assumes development is super risky, when in reality, I think risk is more of built around ignorance more so than what their actual risks are.
Yeah, and that's interesting because I remember a conversation I did have about development in general with someone on this show, and it's actually the opposite, right? He's because we have to account for every element of risk going into these projects because lenders just won't lend if it's not super conservative in the underwriting. And so, in multifamily, we always try to say we're conservative too, but he said it's like that on steroids when you're talking about development because banks, lenders in general, are just more nervous about the risk. So they want to be 100% sure that that operator, developer is very good at what they do, very competent, but that they've also been super conservative in their underwriting out the gate.
Yeah, very true. And there's an interesting thing with the interests that you're paying on construction loans. Because normally we'll raise, say, 40%, and then the bank comes in with the 60% loan to cost. We'll flood the construction with the investor capital first before we start drawing on the loan. And just like a home equity line of credit, you only pay interest on what you draw. So you're throughout those 18 months, you're paying a little bit of interest. Unlike when you buy a multifamily property or buy a single family home, you're paying max interest right out of the gate. With construction, you work your way up until you're almost done, where at that point you're paying max. So the interest rates are less impactful on construction than you would see in a standard just buy and hold. But then back to the risks thing, I always like to say, look how many developers are out there that this is their company, this is their job to food on their kids' table. If you ask them, you're just in a risky business, they're going to be like, I understand it. It's actually not that risky because it puts food on my family's table and I count on it. So risk is all relative, and back to the knowledge of versus ignorance of.
Yeah, and I think most people will just generally accept if something has higher risk, there's the expectation of a higher reward.
Higher reward.
In terms of that timeline, though, you said that like on average 18 months. So is that how long an investor is wrapped up in that deal, or does that vary?
Yeah, so normally it's going to vary, but I would say that 18 months to build and stabilize, we have to occupy it as well before we can sell. So we normally target 2 to 2.5 years.
Okay.
To give ourselves that buffer, but we actually start listing it or teasing it for sale before we're even done with vertical. In the past, this haven't been part of a deal that's gone full cycle or sold early yet, but I've had friends that have a 600 unit built to rent community, which is massive. They just finished the entitlements and engineering, permitting, ready to cut dirt, and they got 2 unsolicited offers. They doubled investor money. So there's a huge demand. The people that are buying these are like the big financial institutions. There was 2 years ago, there was a metric that there was something like $500 to $700 billion of investor institutional money that was targeted to buy these built to rent communities. So there's a lot of demand.
Yeah, and so I guess you just mentioned, so the intent is to get them all rented out prior to selling? Because if so, then that significantly would reduce the risk too for a buyer, right?
It depends on the buyer. Like I said, some buyers are so itchy to get the property that they will actually buy you out and then contract the GC to just finish the bill. There's been stories of I'm 50% built and I got an offer. He bought us out. So this show, there's a ton of demand.
Yeah.
But we don't plan for that. What we do plan on is we build, we stabilize, we have it up for sale. If it doesn't sell, whatever, once you're stabilized, you refinance and then you're sitting on it and you have a stabilized asset and you're cash flowing. You own essentially a multifamily property. So you can play the same exit strategies.
Yeah. And so I guess has anything about your build to rent thesis changed in the current real estate environment, or has it pretty much stayed the same?
It's interesting. I did shift to a different location. I switched operators, but also switched different cities. That's the big one that was really there. I still feel strongly that built to rent's going to be here for a long time. There's a lot of developers that are wrapping up now doing built to rent communities in more and more areas. I think it's here to stay.
Yeah. Okay. So when it comes down to locations, is that primarily because the number of new units that came online was too much too fast in some of those areas, and so it made more sense to move elsewhere? Or what was the reasoning behind that?
There's a couple reasons. One of them, it's got a town that can definitely handle 150 units in this given location. It can handle it, but the growth of doing more and more in that area was like, this might just be a one-off built to rent community and it's a one-off success, but I don't see it being a long-term will just continue in that given area. Where I switched was actually with a different operator as well. It's Phoenix. And this is the interesting thing, because Phoenix blew up and
For sure.
there was a huge amount of migration from California, and now it's stabilized. There's been a recorrection because it was so hot too quick, and now it's cooling off because it's normalizing. But the amount of industry that's moving to Phoenix just became the 5th largest city. It's the 4th or 5th, but they just upgraded themselves and they kicked out, I think it was Philadelphia. And they've got billions and billions of dollars of tech industry going there. So they're going to need an incredible amount of more housing. You got to think about right now we're in this correction. They call there's a economic surplus of housing. But when you really dig into it, that surplus, like in COVID times, there could be a surplus of housing because people are willing to live with roommates or willing to live with family. They come up with alternative solutions.
Yep.
But as soon as the market starts shifting again and more people are wanting to get into houses, all of a sudden that supply demand shifts the other way simply because the economy has shifted. But in general, there's, as you mentioned, a massive shortage across the US, something like 3 million housing units short. So I think shifting to Phoenix plus this operator is going to build a ton. The goal is to do 10 years worth of development. That's the fund I'm doing. I'm not trying to pitch my fund, but we're building built-to-rent communities in Phoenix with the option to shift to Dallas and some other big markets for the next 10 years. It's a one-time investment for the next 10 years, and it's a huge amount of growth potential.
Nice. Yeah. And the story in Phoenix sounds very similar to Tampa, where I live, except we got all the East Coast people during the COVID times moving south, coming to Tampa, significantly raising prices, which benefited me because I own a house, but then you get the golden handcuffs you can't sell anyways because right now interest rates are too high.
Yeah.
But I think that's going to continue because of the fundamentals, right? It wasn't just a temporary blip. Once people discovered Tampa, then businesses started, like headquarters started moving down here because maybe they wanted to get out of California or get up from up east. Favorable climate. I'm sure the city and counties were offering tax benefits, etc. And of course, once you have the companies come down, then you have the employees, and it just creates this flow. So it's certainly slowed down since the anomaly that was COVID, but it's still maintained that growth. And I think it's becoming more popular as a destination because people look to Florida and they say, okay, now Miami's too expensive, or I just don't want to live there. What's another option? And that's why Orlando and Tampa have grown so consistently, I think, over the past 5 years, I'd say.
It's not about the macro economy. It's the micro economy. Because if you look at the macro numbers, things never look good. But you go micro and you're going to find little gold mines everywhere.
Yeah, and I think that's why it's so important for the passive investors. If they're looking at these deals, they need to say, why this market, right? And most pitch decks will spend at least a page, sometimes 10 pages on the market, but they need to understand why that market makes sense. What are the fundamentals there, right? Again, is job growth good? Is population growth good? Is there a diversity of employers in that area so that if one goes under, everyone's still doing okay? Because renters need jobs to pay rent. That's just the way it goes.
Yep.
So I think that's really important to understand that, as they say, all real estate is local. So don't go by these broad national metrics to make your decisions. All right. It's been some awesome conversation, but we do need to move into the turbo round. You ready for this?
Absolutely.
All right. So I'm going to ask you 3 questions that I ask every guest that I have on the show, and I just want some quick, honest answers. Here's the first one. What is one red flag every investor should look out for?
So I made a mistake. Actually, I was taught by a guru. I won't say who that guru was, But they were teaching that, and they were even doing deals, including my first two passive investments. They calculated the cash out refi halfway through the business deal, 2 to 3 years after your renovations are done, you get a cash out refi. So that was right in the middle of COVID in fall of 2020. And then 2 years later, we have this big economic challenge with interest rates skyrocketing and cap rates start changing. Guess what? When we go to cash out refi, not only did the cap rates change, but the interest rates changed, and that wasn't correctly accounted for in the underwriting, even though at the time it was conservative. So the deals would not probably have penciled if they didn't have the cash out refi calculated within the underwriting. So here's the red flag. Never jump into a deal that accounts for a cash out refi. You always want a cash out refi option. All GPs are going to do it, but it's icing on the cake. It's a bonus if it happens, but the property needs to be able to withstand itself for the entirety of the business plan and then some.
Yeah, that's a really good point. I think, like you said, most sponsors, general partners, whatever you want to call us, we'll put it in there as an option, but it's, conditions dependent. If the market is favorable, then we can do this. But I've rarely seen it be the exit plan. And if it was the exit plan, then that's not a good place to be right now, because most cash out refinance are now cash in refinances, just based, like you said, on cap rates changing and the rates. It's at a point now where a lot would have to put money in order to refinance.
Yes.
And that's an expensive place to be. All right. Next question. What is a myth about this business that you would like to set straight?
So we were talking risks, and maybe I should delve into that a little bit more. I think that the financial institutions, I talk about this a lot. I'm convinced the financial institutions over the last 40 years have been changing the way we as a society think about investing. Alternative investments, quote air quotes, is perceived as risky. And I don't know, it's like we're born just thinking alternative investments, they're supposed to be risky. What's crazy is real estate's been around for millennia longer than Wall Street. So that something has taught us that real estate risky. Everything has risks no matter what. Never, okay, red flag. If someone says guaranteed returns or there's no risk, run. That's a scam. But real estate doesn't have to be risky. Real estate can actually be less risky than Wall Street. So get educated on it, get with the right team, and you can have asymmetric returns, low risk, high return.
There you go. Yeah, it can be less risky, and I would also say it could be a lot less volatile. Now that's all, dependent on
that is actually there. I have a great chart that shows the data of real estate from 2000 to 2021. There's a Marcus and Millichap chart versus Wall Street. And if you put $1 million in the year 2000, how would it grow? And one of the lines is super bumpy and the other one is a little more smooth, and one ends up actually way higher than the other. And it was the commercial real estate ended up winning out.
Yeah, exactly. I mean, don't get me wrong. Real estate has its moments where the ride gets a little bumpy, but it's much more of a roller coaster, over the long term when you're looking at stocks. Just the more frequent ups and downs. Okay, final question. Flint, what does success look like to you?
You could take this in so many different ways. I'll talk personally. Success to me is getting to that freedom number where I can choose to live my life 100% how I want to live it. And that could be still working. I guarantee I'm still going to work. And still working might be, or will be, putting back into charity. I like Engineers Without Borders, where you go and build clean water filtration systems in Africa or something. And traveling the world. I'm a huge traveler. I've been all 7 continents. And I just think it's hugely valuable to experience other cultures, experience the world, and I want my kids to see that. So give back and travel, and then work whenever I feel like it.
That's awesome. Yeah, I'm right there with you. We're going to be taking our first family international trip. I'm not really counting a cruise. We did a Disney cruise that had 1 day ports of call at a beach that's is not really by any of the locals anyways, but we're going to be taking a trip to Germany this spring break. Already bought tickets for me, my wife, and the 2 kids who are 5 and 8. We wanted to wait till they were old enough to remember it. And enjoy it. So I think this is a good time. So we're going to check out Germany, try to make it over to the Czech Republic, and see what else we can do. So I think it's going to be an awesome experience for them.
We took a 2-year-old to Germany and Portugal. It was an experience.
Yeah, I don't know how much value add it was for them at that time, but you can
No,
tell them
it
about
wasn't.
it later.
And it was a learning experience for us. It's okay. We need to plan travel different now.
Yeah. All right, Flint. Hey, this has been awesome. Please tell our listeners how they can get a hold of you and if there's anything else you'd like to share with them.
Yeah, the easiest is just go to investwithflint.com. It'll take you right to my site, Vestus Capital, but it's easier for people to remember Invest with Flint.
All right. We'll have all that in the show notes for sure. Hey, thanks for coming on. I appreciate you being here and having this chat with me, and look forward to continuing to see you do big things on your journey.
Thanks for having me on.
All right. Have a great one.